No paperwork, more options, no hustle. Download the Dosika app today.
Okay, I think we have enough quorum to get started. Welcome everyone to the CDSC final webinar for the year. My name is Steven Atema. I'll be your moderator for the day. And our guest for today is Ronny Chokaa, who should be who shall introduce himself shortly. Even as Ronny gets started or tries to get his camera and stuff on, I'd just like to give you a brief highlight or overview of what CDSC does, who we are, and maybe why it matters or why it's important for you to know about us. So in simple terms, what CDSC does is that we guarantee transactional trust for all your activity in the stock market. When you buy or you sell securities, we are the ones who ensure that those securities, if you are the buyer, that you receive your shares in your CDS account, and if you're the seller, you receive the funds in your account. So we are like what's the word? We are like a settlement entity that ensures that both parties, but people who are transacting in the stock market, specifically for equities, this is shares, get their shares, and those people who are selling then get their money. So we also do other things like securities lending and borrowing. We have other products that maybe like the Dosika one that you just shared for investors. Some of you maybe have been inactive for a while. You can participate now very easily through the Dosika platform. You can also own more than one. You can also be a client to more than one stockbroker. If your current stockbroker does not have digital channels, you can participate in the stock market very conveniently through the ones that are on the Dosika platform. So without further ado, we're going to make this session a bit light. We're trying to just have an understanding of not only the stock market but even our analyst for for the day. So Ronny, I don't know if you are able to share your open your camera and then introduce yourself before you can get started.
Hello, Steve.
Hi.
Am I audible?
Yes.
Oh, great. Thank you so much, and warm welcome to all our listeners this evening. Merry Christmas in advance. My name is Ronny Chokaa. I am the Senior Research Analyst at Capital A Investment Bank. New outfits, as many of you are aware. A
They may
brokerage
not
that
be.
deals with a brokerage of. I'll introduce Capital A in greater detail in my presentation.
Yes.
But in essence, we are one of the investment banks in the capital market infrastructure that allows you, the investor, to invest either in stocks, treasury bonds, or derivatives. As to who I am, I cover research, or I head the research department at Capital A Investment Bank. I am the face behind some of the daily or even the weekly reports you may have come across from Capital A Investment Bank. And in essence, I endeavor to keep you, the investor, abreast with all the vital information you need to know to make the investment decisions you take. So my domain of coverage ranges from macroeconomics, equities, and fixed income analysis. My experience in the market spans now well over 2 years now and counting. And yes, I'm very happy and delighted to be here. Thank you.
Mm-hmm. Thank you, Ronny. And before you even introduce the stock brokerage firm or the investment bank that you work with, I think it would be good also for the audience to just get to know you as a person before we even now talk to you on what the subject of the day is. So I wanted to just understand. I'm sure there are some audience here, maybe people who are in different professions, and they're wondering, how does one become an analyst? So if you could be so kind to share how your journey has been to becoming an analyst. Some people who are regular visitors or regular guests to our webinar, they might have seen you in different farms, and they might be curious, what is so special about Ronny that he seems to always appear as an analyst, but for different farms. So it will be just an interesting view to get to know your journey and understand how it is that you chose this line of work.
Oh, thank you, Steve. I think growing up, I always had a liking for math. Math was definitely one of my favorite subjects. I thoroughly enjoyed statistics. Basically, being able to summarize large chunks of data and getting, some meaningful insights out of it is something that I grew up enjoying. I think that informed my move to pursue a degree in economics and finance at Kenyatta University, wherein I was trained on the thinking of how to correlate macroeconomic events with the performance of various asset classes, as we shall attempt to do today. And also during my university career, not only did I pursue some extra qualifications in statistical packages such as Theta, Gretel, and so on, but I also had a hands-on experience with research, especially culminating in my final year research paper, wherein maybe I can just briefly mention it. I was covering the socioeconomic determinants of food access by street persons in Kenya. I know it's a bit different from what I'm covering right now in as far as financial markets are concerned, but that covering that research, which was primarily secondary data based, gave me a thorough introduction to, or prelude, as it were, into research as a career. And just a few months after finishing my final papers at the university, I got an opening at one of the brokerages called Genghis Capital, where I started off my career as a research analyst. Coming into the organization, of course, of course, there's usually the gap between theory and practice. So I was fortunate to have a mentor who guided me. He went by the name George Bodo. Unfortunately, he passed on a year ago. Rest in peace. So yeah, he mentored me on the practicality now of financial market performance, what to look out for, both quantitatively and qualitatively. So that gave me a very solid background, and on top of course, the theoretical foundation I had, they propelled me to pursue or to where I am today. Yeah. So before, how do I get at Capital A? So just prior to that, after close to 1.5 years stint at Genghis, I moved to AIB Axis Africa. I also headed the research department for about a year. And more recently now, I joined the Capital A outfit, which is the latest or the newest baby in town, as we say.
Okay, that's pretty interesting. From your interesting topic in research of in your undergrad research, and now you're doing analysis the financial markets. And I think it's also worth mentioning that you're also currently doing a master's, at least in the financial space. So that from what the few bits that I picked, maybe just mentorship, focus, and I guess when you are in an industry and you perform well, then I guess things just what's the word? Things just work in your favor, because a lot of guys are also trying to aspire to be, especially in this industry that is growing at least in the Kenyan space, and globally financial analysts are some of the top earners in the developed world. So as I believe, even as our country evolves, chances are also this market will evolve, and also this will be part of the careers that people will be aspiring to to work in, and it's good that some of you guys, the young guys like you, are becoming pioneers. Just as we carry on, and I would like to understand in very brief, how we receive your reports, and I'm a reader of most of your work, and sometimes I suspect even some of our readers who might not be reading your work, but they read research reports. I just want to understand, for the sake of my audience, that how do you go about making or coming up with a research report or an analysis? What is the process? If you can just briefly highlight how it goes, so that whatever we see is actually something believable.
All right. So the research process, right now, we've really crystallized it into very simple steps, thanks to some algorithms we've been able to develop over time. But in principle, the research process is very simple. First, you need to obtain the raw data that you're looking at. For instance, if it's the stock market, how do we generate, for instance, daily reports? So that has to start with getting the raw data from the NSE on the trading statistics for the day. So we'll derive a list or an Excel file containing all the companies in the NSE, their trading volumes, highest traded price, lowest traded price, and so on, including even the volume of shares that have been traded that day, foreigners' participation, foreigner buys and sells, and using that raw data, depending on now what questions you have in mind, what information do you want to extract from that set of data. Those questions will lead you to perform certain sets of analysis. For instance, if you want to compute, let's say, the top gainer for the day, we'll basically have yesterday's prices for all counters, compare that with today's prices for all counters. We'll basically do a percentage change and then do a ranking, or perform a ranking from the first to the last. That's how we generate the top gainer, for example. So the good thing is that now the softwares we have made it very, very simple to program, and now we're able to generate simple algorithms that can auto-generate reports in as quick as 10 minutes after the close of the market.
Okay, I think somebody can have an idea, and there is a whole lot that goes into doing the reports, and I'm sure you've just tried to summarize. But with the experience and of course sometimes I believe even intuition, when you're making predictions about what would happen in the market, experience also comes into play. I would just urge you, even as you continue speaking, to increase your volume, because that is part of the comments that you're receiving. Maybe you're not as audible as the audience would like. And also for those who are asking for the recordings, yes, we shall be there, but please try to be here until the end, because that's when you usually get the best. When you wait for the recording later, sometimes it's not as good as when you're watching it live or getting the answers live. But one final thing before we go into the presentation, and of course we shall get into understanding more about you and how you approach investments and life. But what if somebody were to come here and say, this guy has like 4 or 5 years experience doing analysis in the stock market, and he's what we'd consider an expert. What is it that that investors probably ought to know, but they sometimes either don't know or are ignorant about, that can make a whole lot of difference in their investment life?
Yeah, that's a good question. I think for me, the key takeaways in my 2 years of experience, uh,
Easy.
I think there are a number of vital lessons I've learned by looking at basically market trends over time. And one thing I've learned that when it comes to investing is that a little patience can go a very long way when investing or in capital markets. Oftentimes, we find ourselves, there's a tendency, a behavioral tendency to act on the slightest whim or a slightest decline in our portfolio value, whereas a little more patience would have paid off handsomely in the long run.
Mm, mm. That's true.
So
That's true.
yeah, that's one key lesson I've observed time and time again. And this is basically because when it comes to the stock market, change is the only constant. Right now, you may think a particular blue chip is set to remain undervalued over the next 2, 3, 5, or even 10 years. But nothing could be further from the truth. A slight change in geopolitical events could really alter the sequence of events that leads to an appreciation in your portfolio value um, in a very short span of time. So that's one vital lesson that I've come to learn in my experience. Secondly, I've also noticed that
You're on mute.
oh, sorry,
Yes.
accidental. Sorry, I was saying the second lesson I've learned is that reinvestment is the secret of wealth creation. So oftentimes we tend, or there's a tendency by investors to basically place or invest in a portfolio once and forget about it and leave it to go with the soever direction it may want to. But even in our hypothetical models, I think we even had a webinar last time wherein I demonstrated the power of reinvestment. And what I mean by reinvestment is the periodic top-ups in your portfolio investments over time, be it monthly or even weekly or even at least quarterly. You are always taking the extra step to add to your portfolio, and not only just haphazardly, but in fundamentally sound counters. So, in as much as yes, yeah, an argument may come, why should I invest in a company whose value is declining? But I think the last webinar I demonstrated clearly that even when the share price of your a very strong fundamentally strong counter is declining, the approach where you reinvest or add despite the decline in the share price has the effect of lowering your weighted average costs. So that sets you up in a much better position for bigger takeoff in value in 6 months or even 1 year down the line than the alternative whereby you decide just to exit at a loss, whereas just a little patience with a little reinvestment will have really turned the tides in your favor. Yeah, so I think those are the two key observations I've come to learn. Maybe they need to be subjected to further hypothesis testing.
It is okay. Those are your opinions, and we shall take them as that. There's a question just before you start your presentation. I would like you to do your presentation, and for the audience who are still wondering what is happening, we're trying to get a feel of the general investment view from an expert, even as we get insights about what exactly happened in the markets over the last 12 months, so that even his presentation might not be so long, but when you have this background of what motivates an analyst to do what they do and their qualifications, it also adds some credibility on the work that he's doing. So one question that has been asked, because our audience is an active audience, they're asking, when you say a time on your long time frame, what is an ideal time frame for investing in the stock market? 6 months, 1 year, 5 years? Just briefly, just say the time frame, and then you can be setting up your presentation as you carry on.
Okay, yeah. So ideally, when you talk of how long term is a long term time frame, when you talk of investing, we are always looking 2 years and above, right? That's over close to 500 days. Yeah, so that's a long-term investing. If you're looking for a short-term or short time frame, then you are not an investor per se. You are trading essentially. You're looking for profitable short-term opportunities to enter and exit, which may require some level of experience to be able to navigate profitably. It's usually riskier compared to investing over the long run. So when you talk of a long time frame, you're talking 1 year, 2 years, and above. Short term, of course, anything below a year
That's good. And I think to just borrow from your view, I think it is, if you look at even the top investors, whether locally or globally, what you see, the top investors, or when you talk about wealthy investors, they are people who hold securities for the long haul. And of course, people would argue, there are traders that are making money, but I dare say the people who are making money actively participating in the stock market are people whose job is to actually participate in the stock market, which is that they are actually professional traders. Like, that is their day job. Now, unless you're willing to get into that space, most of the time you will probably be a doctor, you will be a driver, you will be a marketer somewhere else, trying to earn that daily bread, and then using that money to invest in different asset classes. So when you put your money in an asset class that you want to make those short-term gains, like he's saying about trading, then you also have to be aware that then it might also require you to participate actively in the market, which most of us, the average investor, does not have the time to look at the stocks, do the analysis, and make informed decisions. One would say, okay, but I can read the daily reports, but that's not enough to actually profitably participate in the stock market for the short term. So look at it in the long term, and like you've said earlier, that reinvestment goes a long way in creating sustainable and wealth that you can actually leave to your future generations. But the questions that are coming, please just be a bit patient, because Ronny had prepared a good presentation about the market, and I think we can only debate, or we can only engage further when we actually understand, did the market outperform, underperform, or was it just average in 2024? Thank you. So Ronny, just take it away.
Okay, just give me a minute to share my tab. Could you confirm whether my screen is visible?
It is. It's visible, Ronny.
Okay, I can proceed. Maybe I'll just turn off my video so that the quality doesn't fade away. All right, so yes, the theme of this webinar is the 2024 stock market review, and for context, I'm just looking at the Kenyan stock market in summary, at least for the first 11 months of this year. The organization I represent, again, is Capital A Investment Bank, which is a new outfit, investment banking, offering ideal or timely brokerage solutions on the equities and fixed income space. Vision, of course, to be Africa's leading investment bank, championing inclusivity, transparency, and adaptability, not just in Kenya, but even reaching out to our diaspora clientele. We, again, aim to provide very simplified access to financial markets through innovative and customer-focused solutions. And now diving right into the stock market, maybe just for the sake of any beginner or anyone who's hearing of the stock market for the first time. So we are dealing, when you're talking about stocks, we are looking at an asset class that gives you the opportunity to earn capital gains and dividend yields. We have various listed companies at the NSE. Maybe you, by the look of that snapshot, you can see some of the maybe popular companies that you may have come across in one place or another. We have all in all around 63 publicly limited companies listed at the NSE. And cumulatively, they have an aggregate combined value of 1.87 trillion as of today. And so jumping right into the market performance this year, how has the market been in a nutshell, or at least from January to November this year? So I think this year we've seen one of the greatest turning points for the Nairobi Securities Exchange, more specifically on the equity segment. After years of decline in performance from, I think, around since COVID, around 2020, we are starting to see signs of decent recovery. If you look at turnover is up in double digits to 21.3% to 75 billion in only the first 11 months of the year. Market valuations are also up a good deal, from 1.4 trillion worth of value a year ago to 1.7 trillion. So that's over 300 billion in investor wealth created this year alone, through, of course, all the various companies in the NSE. Even the indices reflect that. All indices are up in double digits on a year-to-date basis. And if you look at the split of activity, we are noticing also a reversal in terms of foreigners' participation. After 5 consecutive years of a decline in foreigners' participation, we are starting to see foreigners now come back to the Kenyan market. Foreigners' participation rose from 49.7% to 56.4%. And then it's closer to the historical average of around 60%. And even if you look at the foreign flows, over the past 5 years, they were net sellers on a net basis of Kenyan equities. However, this year we had several months of inflows and a few months of outflows. So the negative outflow, we interpret it as a positive sign, because that's a 90% decline in outflows, which can be interpreted as a net or a contributor to inflow activity, or a predictor of inflow activity in the coming year. Even if you look at the general market price to earnings ratio, that is generally up. And what we interpret that ratio telling us is that, for one, the market is predicting, or this ratio is predicting, improved earnings per share over the next 1 year. So this means, in essence, that investors are willing to pay 11 shillings for a shilling of EPS when last year they were only willing to pay 8.4 shillings a share for a shilling of EPS. So that in essence tells us that if earnings per share or company earnings are now being associated with higher dividend yields and capital gains as a result. So that's why we're seeing that rise in the ratio. And just to reiterate, it's predictive. We use it as a signal of positive performance over coming quarters. If we just take a brief snippet at the top actively traded counters in 2024, what stands out is that we are seeing a very huge bounce back in activity on the popular blue chips, led by Safaricom again, which has had a cumulative turnover of 25.58 billion, or just slightly under $200 million, with the bulk of activity being supported or driven by foreigners at 65%. The share closed at 16.55 at the close of November, but today it has closed at around 17 shillings and 60 cents, gaining 6.3% today. On a year-to-date basis, from January to November, Safaricom was up 20.4%. Equity Group came in second with a cumulative turnover of 13.89 billion. Again, with activity being supported by foreigners at 68.7%, to close November at 46 shillings. That's a 34.5% gain since January to November. KCB came in third place. KCB, the turnover clocked 9.6 billion from January to November. And with KCB, a lot of activity was driven by local investors rather than foreign investors, to close November at 37.9 shillings. And that represents or translates to a 72.7% gain since January to November. In fourth place, we had I&M Holdings. Of course, we had a big block trade of the 10% acquisition of I&M by Africa Invest. So that's a one-off outlier. But all in all, its share price appreciated by 76.8% between January and November. And East African Breweries came in fifth, with just about 3.7 billion worth of trades, largely foreign driven, and that counter also recorded a 46.5% year-to-date gain between January and November. So by and large, if you look at the actively traded counters this year, if you just look at the last column, all the counters, save for British American Tobacco and BK Group, have closed in the green. So that means, especially if you look at Kenya Power there at number 13, standing at a 155% gain between January and November, you can see for sure that the stock market is a proven route to realize supernormal returns, or returns above what we usually deem risk-free or riskless rates of return. If we look at the top gainers and losers for the year by share price only, we can see companies growing by triple digits. East African Portland Cement being a very fine example. Since the year started to end of November, the stock has almost quadrupled. In fact, quadrupled in value, from around 7 shillings to now at 35.55 shillings. So that's a 344% gain, followed by Kenya Orchards, 259% year-to-date gain, and Kenya Power, as I spoke on earlier, 155%. We can spot I&M Holdings at 76%, KCB 72%, Kengen at 71%. We have Standard Chartered Bank 56.3%, East African Breweries up 46.5%, and Bamburi 41.7%. On the flip side, we have fortunately, we don't have any company that has lost triple digits. So the largest loss being Kenya Re, and of course that can be explained by the bonus share issue, which in essence doubled the supply of Kenya Re shares in the market. That meant the price had to half in value. So that's the effect you're seeing there. Other than that, we have Nation Media Group also down 40%, Standard Group, Sanlam Kenya down 33%, Sasini down 25%, TransCentury also down 25%. We have British American Tobacco down 17%, and Flame Tree down, closing the bottom 10 at 14.9% decline. But net, we've seen one of the most significant recoveries yet, and we still believe the recovery is ongoing as we discuss. And I think maybe just to mention, I think the major turning point for the stock market was the change or the turning of interest rates from the higher for longer to the lower for longer. And what I mean by that is that generally over the past 2 to 3 years, interest rates were elevated both in developed markets and right here in developing markets. And the net effect was that high interest rates highlighted the attractiveness of fixed income securities relative to equities. And that's why over the past 3 years, we've been seeing net outflows by foreigners and basically bearish trading activity on even our very fundamental blue chips. However, we know that has since changed. Interest rates took a different turn since September this year. We started to see Fed rates coming down, and that, of course, trickled back over here, where we saw even the central bank, our central bank here, begin to implement rate cuts. Furthermore, I think we also started to see the signs as early as Q1 when Kenya refinanced the Euro bond in February this year, and consequently we had some reforms to the FX market that brought some significant stability to our exchange rate. So that led to a rebound in investor confidence, as it were, and that explains some of the why a huge percentage of our blue chips are now closing in positive gain territory. So I hope that gives you a good grounding as to the market performance this year. And as for our outlook ahead, 2025, I think it promises to be yet another significant. I think we still have some price recovery to realize, especially on the blue chips such as Safaricom, Equity, KCB, which have been significantly discounted over the past 3 years. So especially now that interest rates are coming down, from historical correlation, we know that bonds and equities tend to move in opposite directions. So right now we expect, now that yields are coming down, we expect generally flows to increase onto the equity side, and as such we expect further price appreciation on a sizable number, in fact, of blue chips. And for purposes of our first-time investors, maybe for some of them listening, maybe I can also take some time to highlight the risks in the equities investment process. Yes, as you can see, even from this slide, some counters are closing in the very positive territory, while others are closing in the green. So sometimes yes, those are two possible realities, and they can be explained by several factors like market risk, which is attributable to general market forces. For instance, movements in interest rates, as I was describing, can have an impact on broader activity in the equities front. So that fortunately has worked now in the favor of equities so far since Q1. We are starting to see, generally speaking, a recovery in our equities front. But if at all we have, let's say, some geopolitical events that lead to an upsurge in inflation, generally we expect the central bank will have to tighten interest rates to anchor inflationary pressures. That again may affect the performance of the stock market. The other factor, of course, is business risk or the company specific risk. So this relates to the quality of management. If at all management are not making as strategic decisions as they ought to, you can obviously expect poor performance from the counter. So it may not be a market factor. All other companies in the same industry may be doing well, but the company you selected may not necessarily do well because of the company-specific management factors that need also to, of course, be promptly addressed. We also have regulatory risk, which can either support or compress industry earnings. Maybe, for example, in the banking sector, we have the risk-based price lending, which allows banks to exercise differentiated risk pricing that supports the earnings outlook for banks. On the flip side, we can have, let's say, an increase in excise taxes on manufactured alcohol, on beers, and so on. That can, of course, you can expect that to compress the earnings of a company like East African Breweries. So it can work both ways. We have social and political risk. And a good example of this is during the anti-tax protests around May, early June, we saw a very certain and unmistakable decline in our equities performance almost immediately. This shows you how political stability is very, very amenable or very, very key in determining equities returns. So we saw some of our blue chips trim down a little during the protests, but amid the return to relative political calm, we started to see the recovery kick back in. So these are basically some of the factors that I felt I needed to highlight to our investors, especially our first-time investors, to better understand or better contextualize why some counters are doing well, why others aren't. Yeah, I think at that point, I can close the presentation for Q&A.
Thank you. Thank you, Ronny, for that big presentation. And hopefully our audience has been able to capture the highlights of the year. And generally speaking, from my view, you're saying it was a stellar year for the local markets, and anybody who is invested in most of the counters, if you just go by the all share index, they were probably making positive returns But and I think it also goes into what you were saying earlier about the bit about investing consistently. So if somebody was participating in the market left in 2018 and they're looking at the stocks right now, they're saying that's not a serious gain. If I bought those counters when they were the highest, but if they were continuously buying them over the years, they would be experiencing some very serious growth. I just want you to maybe just summarize what stood out for you in 2024, both locally and globally, in simple language, as an investor and maybe as an analyst. What actually were the things that you noted in 2024 for the local market as well as for the global side?
Thank you, Steve. I think 2024 was a year of unprecedented volatility. I don't think there are hardly few examples in the history of the stock market where we've seen some stock markets move from, let's say, the worst in the world to the best in the world in a period of 1 quarter. So, and I'm only talking about Kenya here.
Yes.
And not too far out there. The example is right here at home. The Kenyan stock market has really given us a run for our modeling. I think very few models are able to, predict or foresee that extreme volatility that we saw this year. I think a number of forces shaped, globally speaking, has to do with the geopolitical landscape. With everything going on in Russia, Ukraine, and more recently the tensions in the Middle East, we know that the central banks, key central banks, US, UK, Japan, and so on, were keen on anchoring their monetary policy to prevent inflation. So that made fixed income securities very attractive. That was 2022, 2023. However, 2024, around June to September, sentiment started shifting. This was because inflation had cooled down significantly, both in developed markets and even right here at home, allowing central banks to ease interest rates. That really supported the equities outlook. Even in developed markets, this was true. We saw, for instance, in the US, the S&P 500 index climbed to the all-time high, I think, of 6,000 points. So that showed you an almost instantaneous response to changes or the developments in the global market. Furthermore, we know that this was the year of unprecedented set of general elections. Of course, in global market terms, we know, say in the US, we had the Trump versus Kamala, and of course, Trump carried the day. So, in as far as that affects the global equities outlook, markets are anticipating tax cuts for US corporates. So that should support the earnings outlook. And I think that even if you look at the charts with the Trump victory, we noticed equities moved even higher as a prediction of or as an affirmation that the tax cuts are certainly on the table. However, globally, I think the picture is not so uniform now that we are also expecting tariffs to come into the picture, with US and China trade wars re-emerging once again. So that again presents an upside inflation outlook, so to say. But all in all, if we funnel down to our Kenyan equities market, I think we've had some significant factors that have played in the favor of our market. Firstly, as I was describing earlier, the repayment or the refinancing of the Eurobond that was due in June this year, which was paid in February, and the last installment in June.
That was this year.
Yes, it was this year.
This has been a very long year.
Yes, it was.
Yeah.
Subsequently, the central bank implemented a set of reforms to the FX market, which really enhanced the stability of the Kenya shilling. Thirdly, we saw the central bank really show up foreign exchange reserves. Now we are back above the minimum 4 months of import cover. So all these factors collectively have enhanced investor confidence, both globally and domestically, and allowed for a brimming recovery, or a bull run, as it were, that we are starting to see in more clear light.
Okay, you can answer this in brief. How does the stock market compare to mutual funds or fixed investments? You can speak on the two, on what makes those two different investment options, stock markets and the unit trusts.
So with unit trusts, I think we have different categories of unit trust depending on the risk profile of an investor. We have equity unit trusts, or unit trusts that invest in a portfolio of various stocks. So the importance or the appeal of a unit trust is that it gives you access to a diversified portfolio rather than going all in on one specific stock. Yeah, so unit trusts give you that diversified risk exposure, which, in as much as it may reduce your potential return, it also significantly reduces your risk exposure, where that arises when you invest in one single company. But in our ecosystem, I think the more predominant forms of unit trusts have tended to fixed income investments.
Yes. In fact, his question was likely towards that.
Yes, the typical unit trust in Kenya has a larger exposure to fixed income rather than equities. So that has meant basically you're getting risk-free. You're getting the standard risk-free return. You have very little exposure to the equities markets. Yeah. So I think that highlights the basic difference between the stock and
mutual funds, or in Kenya mostly what people call money market funds, invest in fixed investment income securities like bonds, and equities are the shares that you see listed on the NSE. So they're a bit different, and of course the equities are a bit more volatile, but they also have higher return. They are called fixed income instruments because the return is fixed. The other question is about Kabasid. Kabasid was not on the top gainers, neither were they on the top losers. Are they worth holding over the long term?
Okay, so with Kabasid, so among the counters for which we are tracking actively, Kabasid we currently do not actively track, or haven't been tracking Kabasid as the counter. But I can endeavor to do so and then maybe revert to you on my outlook on Kabasid in the coming week.
When you share your contacts, they shall be able to reach out to you on that. Key lessons for portfolio diversification and risk management in 2024. What are your key lessons for portfolio diversification and risk management? I think you had covered some of this, but maybe just add some color.
All right. I also do enjoy portfolio management. So some of the lessons that I highlighted at the very start touched on that when I spoke on reinvestment being one of the secrets of wealth creation, and that a little patience goes a long way. But on top of that, I think some of the key insights I've come to learn is that now that the NSE evolved or introduced the derivative segment, it offers additional opportunities for investors, not only to hedge, because we always talk of hedging risk using the derivatives market, but it is also an opportunity to increase your overall portfolio returns. If, for instance, for companies that are bullish in the stock market and are expected to remain bullish over the next, say, 1 year, then the derivatives market is a way to compound your returns. But if you take a contra position in the derivatives market, you're basically hedging. So you're not in the action really, because you're long on the stock market, but on the derivatives you are short. So net you're not getting any action. You're just paying out transaction costs.
Yeah, true. I think some investments you have to do the math to see what exactly are you doing. You're doing a lot of exercise, but the fat, you're not trimming the fat. Okay. But
the derivatives market offers a very lucrative opportunity for investors looking ahead into 2025.
Okay. What about HFC? What are your comments on that rights issue? It's undervalued. Is it undervalued, or is it a good investment for long term? I don't know if this question is overtaken by events, because last I checked, the rights issue closed yesterday. But you can speak about it, Ronny.
Well, yes. With HF Group, one of the things that stood out bizarrely after looking at their numbers is that I noticed some of their capital adequacy thresholds below what the CBK recommends as the minimum safe capital threshold. So for us, we interpret that as, not so positive signal. So that is one counter for which we retain a bearish outlook on. For
that is HF
reason. Yeah.
Okay.
Yeah, but hopefully with this rights issue, they should be able to restore their capital buffers back to the CBK minimums or above the CBK minimums, and that should again now take us back to the modeling board to see whether their outlook is as positive after the rights issue.
Okay. Another question. They're coming in hot and fast. You might have to be very fast also in your response.
Okay.
This one, I think I'll save this for later. But let me go to this other one. What about the relationship between US and Kenyan stocks? I don't know if you had made it clear, but people want to understand what is the relationship between the US and Kenyan stocks with regards to performance and crashes. When the US stock market is bullish, does that affect Kenya? And also when it's bearish, does that also reflect in Kenya?
I think there's some correlation. They tend to move in the same direction, but it's not necessarily true that the US stock market's positive performance causes Kenya's stock market to perform positively. One is not the cause of the other, in as much as they both move in similar direction. But what I can say to this is that by and large, the patterns that hold true in the US market, the sectors that are outperforming in the US stock market, for instance, the not telco, but rather technology sector in the US that has really outperformed this year, coming on the back of the AI revolution that's still ongoing. With companies such as NVIDIA taking the charge, we've seen some astronomical returns on themes such as ESG investing and AI. Financial services has also held up, and this has also been true in Kenya. The financial services sector has held up despite the volatility that persisted, despite the inflation and what have you. We still saw the financial service, the banking sector in particular, hold strong in both markets. I think Kenya has some nuanced features now that there's also the element of exchange rate movements that alters different industry dynamics. For instance, for exporting oriented companies, especially in our agriculture sector, like Sasini, Kakuzi, some of them have even issued profit warnings coming on the back of the strengthening of the Kenya shilling. You know? So the strengthening of the Kenya shilling has actually compressed their earnings when they state them in Kenya shillings. And the vice versa is true for companies which have less reliance on exports, but they are more import oriented. So companies such as, let's say, in the manufacturing sector, companies like BAT, you'd expect them to realize a lower cost of sales.
In fact, now that you've gone to BAT, can you answer this question? Your thoughts on BAT and Bank of Kigali Group long term?
With BAT, this year their trailing earnings are moving down. I don't think they'll even be able to sustain the dividend they paid last year. Earning, and this is a revenue problem. Revenues have been on the decline. And there's only so much you can do. There's only so much cost management you can carry out if revenues are declining. You know?
I thought people are buying is it Velo or what is it called?
Apparently not so much as
it's big
because of
if this is speculative, but it's big for the big what are they called, big cigarette manufacturers. I think if you follow the global news, what is it called, it's so big in US. I forget the name that it's branded in the US market, so I had assumed that naturally it would be very popular among the young demographic, because it's very big in Europe and in US, and cigarette manufacturers are like having they're like oil companies in the Trump era. So there's a resurgence that I thought would also trickle down to BAT. I don't know. I don't know. I feel like I would not write them off just yet.
Yeah, but I think in relation to that, I think that particular product was the subject of legal battle, particularly in relation to its legality
Effects
in the Kenyan market, and the concern, of course, being the adverse effects. So that is still a subject of ongoing debate. So that has adversely affected BAT's earnings, as you can imagine.
So you're saying, just so that we can move faster, you're saying medium term it's going to stagnate. You see stagnated earnings, but long term, it's anyone's guess.
Yeah, I think you crystallized it perfectly.
But so anybody investing in BAT between now and in the next 2 years, you might be, if you already have it, hold. If you don't have it, there are better counters as highlighted in the performance. I think there was a question that I didn't want to miss, which was that when you speak that I jumble up some of these questions because they're related, but there was a question I believe that somebody had asked, which was now that you've given those highlights of the top performers, are they still undervalued despite their gains? Or I think he's asking that, considering most of those counters have already done double-digit growth, is it still prudent to buy them now, or are they already out of the are they already post their earnings, at least in terms of the price appreciation?
Yeah, that's a very important question. That's a real investor right there. So is it too late now? Have I missed out on all the action? Yeah, to put it in other words, I think they still. I think I said this in my presentation. I think we still have some price discovery to realize, especially noticing that some of their blue chips are still trading below pre-COVID-19 levels. However, when you look at the context now, the sentiment has really shifted. Stability has come back to the picture. Interest rates are now back to pre-COVID levels. Inflation is at multi-decade lows. So broadly now, we think we have all the favorable conditions to have a smooth offtake in our equities market. So are we too late? No. I still think we have some significant price discovery to unlock next year.
That's good. HSR, no, it's not VEP. VEP is something else. Ronny, there's another question about, and I think this is also related to what you spoke about, so I would not expect you to dwell much on it, about how global macroeconomic trends and geopolitical tensions are shaping up the stock market and your view of 2024. I think I would just add you to maybe add on that on how these macro economic situations or conditions affect our stock market, but also add on top of it what he's asking for, what should investors watch out for in the coming year.
All right. I think in my training as an economist, what I've come to see more clearly is that there is a very sure and decisive correlation between macroeconomic events and the performance of asset classes such as equities and bonds, etc. So geopolitical events that disrupt global supply chains, impact inflation, they dampen investor confidence, and we know confidence is worth more than money. Yeah. So when so when that confidence is shaken, investors tend to hold back. And that was the case over the past 5 years with the COVID-19, Russia, Ukraine, and the consequent rapid tightening of monetary policy. However, we are now starting to see an unwinding of those risks. And looking ahead, I think we are set to, we have a sort of a soft landing that now will allow for a smooth takeoff, or a smooth, first of all, recovery back to pre-COVID levels. And then assuming no other risks emerge, no other Russia, Ukraine coming into the picture. Of course, now we hear South Korea impeached their president more recently. Oh, is it yeah. So with that kind of political uncertainty, if it spills over or broadens out, then risk on means central banks will have to come back again and tighten interest rates, which is really not markets need at this moment. But by and large, I expect markets to remain fairly calm.
Yes.
From the best of my knowledge so far.
As an investor, what should I do, if I can just put it simply? And yes, Momo, the pouch I was referring to is Zine or Zine or Zane. That's what is doing a lot of is very popular right now in the US and EU. So for just to summarize, because there's also another question about 2027.
Yes.
And people just want you to tell them what should I as an investor do in the coming 1 or 2 years? Should I operate as if nothing is happening, or should I, take a reserved approach towards my investment? Especially for guys who are saying, okay, Kenya is already looking like it's heating up for 2027. The other guys are saying we don't know Trump. If you are investing, the diaspora guys are saying we don't know what Trump will do. So, as an analyst or as a professional in the field, what would you tell any investor to do as they plan for their 2025 investment?
Okay, I think in maybe I can use an analogy to drive the point home. In simple terms, I'm saying the storm is over, and I think it's time for investors to dip a little now back into the ocean.
Okay.
Yeah.
So you're telling us not to be afraid.
Don't be afraid. The storm is over.
Okay, I think I'll take your word for it. There was a question about if somebody wants to get in touch with you and Capital A. I think you might want to share your contacts, but we shall also share the recording and presentation on your emails. So, but you can share your contacts, not your personal, but your work contacts here for your audience to reach out to. And also, yes, this was also what I was getting to close on. Your top 3 picks for 2023, 2024, and your top 3 for 2025. If they're the same, you can just mention the 3. There's a question about an analysis, your methodology and whatnot. I thought that question is better answered in a different session, but if you want to take it up, I would not object to it, though I'm trying to also be mindful of time. I want us to close in the next few minutes. But there was a question by a lady called McKenna, who was asking about how to do qualitative analysis and the tick points that make the counter a good buy. I would recommend we take it up in a separate session, but if you can have a quick answer, I think it would be good to help address that question. How do you do quantitative analysis, and what tick points do you use to decide whether a counter is good or bad?
Okay.
Yes. A good buy or a bad buy.
All right. So when looking for a good buy, I'm first look at the earnings quality. And the rule of the thumb, if earnings are on a decline, I'd want to, reconsider that investment or set it aside and look at counters which are recording a positive earnings momentum. That is when I compare trailing earnings this year versus last year. Another heuristic I usually rely on is looking at counters with consistent dividend payout policy. Companies which are giving competitive dividend yields relative to the industry average. The higher the better, of course. I want to look at counters which have consistently high return on equity year on year. That is on the quantitative side. Qualitatively, you want to listen to what management is saying in terms of their forward strategy, listening to, of course, their interviews and even going through their annual reports. Those give you the qualitative aspects that you really need to, in as far as their strategy is concerned. Everything rises and falls on strategy. So I think that also ties to this second question on what are the qualitative metrics to look at. So qualitatively, you want to look at management's outlook on the industry and even their company's positioning. You want to look at their strategic priorities. Where are they looking to expand into? How are they looking to expand their market share? How are they looking to grow their revenues? Those are qualitative aspects of information that reinforce or support your quantitative analysis. So
Okay.
I think at that,
Yeah.
I can sign off by
Yeah. I'm
giving
loving the questions being being asked by the audience, and I really wish we had more time. So I'll just let you answer two questions. The first one is, what are your thoughts on KCB given they're offloading NBK? I would say good, but but I want the analyst to speak on that. KCB's selling of NBK, and then finalize with your three best stocks of 2024 and your three top stocks for 2025.
Okay, so my on the first question on my KCB outlook, I think they've done a really good job in turning around NBK into a profitable business. I know they still have some cleaning up to do in as far as their NPLs are concerned. But all in all, there's a significant turnaround on NBK, and I think the deal is very ripe for consummation by Access, maybe early next year, hopefully. So all in all, if you look at KCB by half year, their earnings were up very strong double digits, 85%. By Q3 up 45%. So you're looking at a counter that's on a very, very firm recovery. I know, yes, admittedly they have some work to do with their NPLs, but the earnings momentum is robust. Their net interest margins are unscathed by the market interest rate movements. So KCB is definitely a counter that I'd add to my basket 2025. So far this year it is up 76%. It was trading as low as 16 shillings at some point, but now it's at 37 shillings. So
I'm also tempted to ask, like my friend who asked about whether it's a good time to buy. 76% is a very good gain for any investor.
Yes, yeah.
So your
but I
top
still
three?
think because yeah, all right. So top three stocks for 2020. My top picks for 2024 were KCB, I&M, and SCOM. I think
And what?
net KCB is Safaricom.
Oh, Safaricom.
Yes, I think net KCB took the year so far, together with I&M, both at upwards of 70%. Safaricom is still lagging behind the two, but I still think it has some recovery to pricing. For 2025, I'm looking still at Safaricom. I still believe there's some significant recovery to be priced in. I'm also still bullish on KC because if I look at the price to book ratio, it's signaling or it's screaming an evaluation. So those are my top two, and the third pick, of course, coming into the energy sector, I'd tip Kengen to to record some sizable valuation gains 2025. Yeah.
That is also while it is in the equities, it is at least diversified. You're doing a banking, you're doing telco, and you're doing energy. And with that, I think it's a good time to end our session. Thank you very much, Ronny, for that very engaging and also very sharing your personal journey being an analyst. For those people who would like to engage with Capital A, where can they find you guys? Have you shared your contacts on the chat, or how can they reach out to you guys?
All right. So you can reach out to Capital A Investment Bank by visiting our website, www.caib.co.ke. Or alternatively, you can reach us by email, info@caib.co.ke, or if you want to email me personally, you can just drop an email to rchokaa at caib.co.ke.
Thank you very much. And when you go to their website, I'm even sharing with you. They have I think this is a redone website after the rebrand. When you go to their website, all the information you need about the research, the contact information, where they are located should be available there. Let me just copy that and share with you guys on the chat. Having a challenge with pasting. And thank you very much again, Ronny, for making time. You're always it's always a pleasure hosting you in these sessions, because we get more than what we bargain for, and it's always it's always good to get additional insights. As I try to paste this site link, can you also share? These days everybody does podcasts. What podcast do you listen to that keeps you on edge in the financial space, or any other? Or are you a
I'm
book
honestly
person?
I'm honestly not a podcast guy.
You are a book.
I like more visuals. So
What book would you recommend to our audience for Christmas?
I'd highly recommend Thinking Fast and Slow by Daniel Kahneman. It's a book on behavioral finance. It teaches you your own biases when it comes to investing, so you'd be more self-aware approaching the stock market in 2025.
You said thinking what?
Thinking
I also want to read the book. Thinking
Fast and Slow.
Thinking Fast and Slow. So guys, there you have it. Thinking Fast and Slow. If you want to also get further insights about how to participate or be a more effective investor, and probably even a more effective professional wherever you are. So thank you very much again, Ronny, and thank you guys for showing up and staying with us for 1 hour, 30 minutes. Have a lovely night, evening, morning, wherever you're watching from, and happy holidays. Bye.
Bye.